Hello, good evening, and welcome back again to another discussion on financial reporting. Today, I'm going to discuss about changes in group structure. What I'm going to discuss today is about changes in group structure. So, what happens is when a parent acquires a subsidiary, and then they retain the subsidiary for given several periods, and then subsequently what happens if the parent decides to dispose some stake on this, and that becomes the changes in group structure. In order to understand that, we just look into this diagram which elaborates the time frame. If you look in here, during this period up to here, during this period the investment, we call it ordinary investment. Usually in this situation we use IAS 32, 39, some of them has been superseded, then IFRS 7 and IFRS 9. We use these standards in dealing with investments which are less than 20% stake in another company. When the investment exceeds the parameter or the threshold or brackets between 20 and 50% during this region or regime, and that when the parent acquires significant influence over its investee company, when we then refer that as associates. We refer that as associates, and we account using IAS 28, investment in associates and joint venture. Once the threshold exceeds 50%, starting with 51 up to 100%, this regime, then we name it that investee company as a subsidiary when the parent acquires control over the subsidiary. This is the normal flow regarding the investment, and then sometime also stepwise in acquisition of the subsidiary. However, the parent may also decide to dispose. When the parent decides to dispose, what happens? This is 100%, this is 50, this is 20, and then 0. So the journey moves this way. Where when a parent may have 100% stake in an investee company, and at that time we name it fully owned subsidiary. That could be fully owned subsidiary. The moment when the parent is disposing some of their shares to some other entities or shareholders, then the ownership stake started reducing. This could reduce and reach to different stages between 50 and 100. So for example, let's say they have sold 40% of the stake from 100%. Then what happens? They come to a situation where the investee company, the parent retains 60% of the shareholding, and yet parent company also retaining the control. In that situation also, we call it, this is a subsidiary, but which has non-controlling interest. So accounting treatment when come to any disposal of shares and still the control is retained, then yet the parent company need to consolidate the subsidiary. For example, let's say you have the parent. This is 1st January 2020. This is the acquisition date. The parent acquiring the subsidiary on 1st January 2020. On 1st January 2022, the parent is disposing the shares. And this is 31st December 2022. That's the balance sheet date. Now, with regard to my previous example of when parent is disposing only 40%, so on this during this period, the parent should consolidate the results of parent and subsidiary together. Even during this period also, the parent should consolidate. Why? Still the control is retained by parent. Still the control is retained by parent. So the parent on this date as well need to prepare consolidated financial statement. Very clear. However, if that because of that disposal of stakes, the ownership goes below 50, such as let's say 45%, meaning they have sold 55% of the ownership. And then the question is whether the parent is retaining the control unless otherwise according to the references given in IFRS 3 and 10, you have to verify whether control is retained. When the control is not retained or control is lost, when the control is lost, then on this point of time, that investee entity becomes an associate. In this situation, what happens? 1st January 2020, 1st January 2022, 31st December 2022. During this period, the parent should consolidate the subsidiary. They should consolidate. They should consolidate and prepare consolidated financial statement. But once the control is lost, the control will be lost on this date. Control is lost, then the parent should prepare standalone financial statement only for the parent. Only for the parent. In both the situations, what you should do actually, first in standalone financial, you should calculate profit or loss on disposal. What you need to do, you have to calculate profit or loss on disposal. How you do that? Fair value of consideration received. Fair value of consideration received, which is whatever the amount is, minus net assets disposed at the date of disposal. Then the resulting answer is either profit or loss. Profit or loss on disposal. Now this answer should be reported in the P&L of parent, individual financial. This should be reported in the parent's individual financial statement. On the other hand, we also need to calculate consolidated profit or loss on disposal. What the difference here? What you are doing here actually, you will have the fair value of consideration received, whatever the answer, minus net assets disposed at the date of disposal. Here you take the net asset of the subsidiary and if you have done any fair value adjustment during the time of acquisition, if you have done any fair value adjustment, that fair value adjustment also we needed to incorporate here, and also any goodwill that is resulting from this acquisition, that also we need to edit. So we will add all this, and then we will subtract the non-controlling interest at fair value. Not at fair value, at the date of acquisition. So we get this answer, and the resulting answer will be consolidated profit or loss. Now, what we need to understand here, one important point is that the goodwill and the NCI. Students are advised to know how to calculate goodwill. Calculation of goodwill and also calculation of NCI at the date of disposal. Now these two calculations you have to do as a working in order to supplement that as part of two line items in our previous above calculation. So here there are separate workings, and that I will discuss in a separate video. Students who are interested, please tune on to my YouTube channel, that will have more details on that. Now here again, one more thing the examiner may expect is that reconciliation of profits. Reconciliation of profits between standalone company and consolidated results. So here, that is another requirement. This would be tested as a multiple choice question. Actually this video will be more suitable for financial reporting level at ACCA or any other exam which are equivalent to that. So here what you do is that you would have the profit as per standalone company, profit as per group, meaning consolidated. You get the difference, and this difference works out to be like this: net assets at the date of disposal, net assets at the date of acquisition. Find out the difference, and group share. Suppose, for example, if it is 80%, what you do is you multiply this by 80%. This resulting answer will be equal to this. Thank you very much for watching this particular video. This video is only discussed the theory part related to group structure, is suitable and applicable to financial reporting F7 level of ACCA or any other equivalent exams. My request is that I would be recording different videos. In the next videos will be to deal with some examples and calculations which will elaborate more on this. So once again, thank you very much for watching my video. Kindly share my YouTube videos and subscribe, and also please do press the bell button and like, and also inform all your friends, relatives, brothers, siblings, whoever would be might get benefits of these videos. Once again, thank you so much. Bye bye.